Every American is walking around with a financial shadow they never agreed to carry. It follows them from childhood to adulthood, from the grocery store to their mortgage application, and even into retirement. It is woven into every paycheck, every federal program, every interest rate, and every election cycle. Most people never see it, but it sees them. That shadow is the United States national debt, a number so large, so surreal, that it barely feels real anymore. $37 trillion. A number so big that saying it out loud feels like reciting a myth. And yet, somehow, it is the most real and powerful force shaping the American economy today. To put $37 trillion into perspective, imagine stacking $1 bills on top of each other. The tower would reach beyond the atmosphere, beyond orbit, and stretch roughly 1/6 of the weight of the moon, if every American, children included, tried to pay it off tomorrow. But here's the part no politician wants to say out loud. The US isn't just borrowing money. The US is borrowing time, and time always comes due. People often assume a country paying off its debt is like a family paying off its credit card. A responsible thing, a positive thing, a stabilizing thing. But what if the opposite is true? What if paying off all US debt would not stabilize the system, but shatter it? What if the debt is not a glitch in the system, but the very mechanism holding the system together? And what happens if the world begins to lose faith in that mechanism? Because right now, the US is facing something it has never experienced before. Debt rising faster than population, faster than productivity, faster than inflation, faster even than economic growth. For the first time in modern history, the interest alone, not the debt, just the interest, is approaching the cost of the US military. And if current projections hold, interest payments will overtake defense spending entirely within a few years. That would mean the United States spends more money paying for the past than preparing for the future. And that is the point where empires historically begin to crack. Every great collapse, Rome, Britain, Spain, began the same way when debt, once a tool, became a burden too heavy to carry. America is not there yet, but it is walking the same road. And the world is watching each step carefully. Investors, foreign governments, central banks, all of them are beginning to ask a question that would have been unthinkable 20 years ago. How long can the United States run a system built on borrowing before the math stops working? On this channel, we don't settle for simple answers. We dig beneath the headlines, beneath the political talking points, beneath the surface-level narratives to reveal the deeper machinery powering the global financial system. And if you're watching this video right now, you're part of the small percentage of people who want to understand how the world really works, not how it is marketed. So before we go any deeper, I want to know where you're tuning in from. Drop your country or state in the comments below. This community is growing fast, and your perspective shapes every conversation we have here. And if you're new to the channel, hit subscribe, because no one else breaks down global finance with this level of clarity, intensity, and honesty. Now let us get into the truth behind America's $37 trillion question. What happens if the United States actually pays off its debt? Does it save the economy, or does it collapse it? The answer begins with understanding why the debt exists in the first place. Because it wasn't always like this. There was a time in American history where national debt was small, simple, and even occasionally paid down. But that world is gone. What replaced it is a financial architecture unlike anything humanity has ever built before. An architecture powered not by gold, not by productivity, but by confidence. And confidence is fragile. To understand how dangerous the US debt truly is, and how dangerous paying it off might be, we have to go back to the beginning. Not just to the past few decades, not just to the 2008 crash or the pandemic or the Clinton surplus. We have to go all the way back to the moment the modern American budget was divided into two distinct halves. A split that still defines American politics today: mandatory spending and discretionary spending. That division was the birth of a system designed to function in good times and survive in bad times. But it also created a hidden weakness. Mandatory spending is automatic, uncapped, unlimited. It grows with demographics, not budgets. And that is the spark that would eventually ignite the fire beneath the national debt. This is where the real story begins. To understand the colossal size of today's national debt, you first have to understand how the US government actually spends money. Because unlike a household budget, the federal budget is not a single pool of money that gets divided up each year. It is a dual-engine system, split into two very different categories: mandatory spending and discretionary spending. This division is the quiet, often overlooked reason why the United States cannot simply tighten its belt or balance the budget the way politicians like to pretend. It is also the reason why America's debt has expanded across every generation. Regardless of who sat in the White House or which party controlled Congress, Mandatory spending is automatic. It does not require Congress to vote each year. It is governed by laws passed decades ago that guarantee payments to people who meet specific qualifications. Social Security, Medicare, Medicaid, veterans benefits, federal retirement programs, all of them fall under mandatory spending. In 2024 alone, Social Security made up roughly 22% of the entire federal budget, while Medicare accounted for another 12%. Together, these two programs alone cost over $2.3 trillion. And because they are tied to demographics rather than budget decisions, the cost rises every year as the population ages. The United States is older now than at any point in its history. In 1980, the median age was 30. By 2022, it had reached nearly 39. Americans are living longer, and birth rates have steadily declined. That means more retirees drawing benefits and fewer workers paying into the system. The math is brutally simple: more money going out than coming in. By 2050, the number of Americans aged 65 and older will increase to over 80 million, a 47% jump, while the working age population grows far more slowly. The only thing that prevents an outright demographic collapse is immigration, which accounts for 82% of projected population growth. But immigration is politically volatile, which means the system sustaining Social Security sits on a foundation that could shift at any moment. This demographic squeeze alone would be enough to put pressure on the national debt, but it is only one piece of the puzzle. Discretionary spending, the part Congress actually votes on each year, contains America's most visible expenses, including defense. In 2024, the U.S. spent nearly $1 trillion on its military. Even conservative estimates place defense at 14 to 15% of total federal spending, making it the largest slice of the discretionary pie. But even this massive figure is overshadowed by something far more ominous: interest on the national debt. In 2024, interest payments cost the U.S. government $881 billion, more than Medicare, more than veterans benefits, more than anything except Social Security. By 2025, those payments are projected to reach $950 billion. And by the middle of the next decade, the Congressional Budget Office expects interest costs to approach or exceed $1.7 trillion. In a matter of years, the United States will spend more money servicing the past than investing in the future. No empire in history has survived that trajectory for long. But how did the United States accumulate such astronomical debt in the first place? The common explanation, too much spending or too little taxation, is true, but far too simple. The truth is that America's debt is the result of overlapping structural forces, all accelerating at once. Start with taxes. In the early 1950s, the top marginal tax rate was 91%. Even after deductions and loopholes, the wealthiest Americans paid an effective tax rate of around 42%. Today, the top marginal rate is 37%, and the effective rate for the wealthiest is closer to 26%. As the need for government revenue increased due to aging demographics, expanding programs, and rising interest, tax intake decreased. At the same time, government spending surged during crises. In 2008, to stabilize the collapsing housing market and prevent a second Great Depression, the United States passed the $700 billion TARP bailout and a $787 billion stimulus package. In 2020, faced with a once-in-a-century pandemic, the U.S. spent an estimated $4.7 trillion on emergency relief. When the economy shakes, America spends. And for better or worse, it works, temporarily. But each rescue deepens the long-term debt obligations. Every crisis becomes sediment, layered on top of the last. As a result, America has run a deficit nearly every year for the past half-century. Even in times of prosperity, the debt continued climbing. In the late 1990s, the United States experienced the rarest fiscal achievement in its modern history, a budget surplus. From 1998 to 2000, America actually spent less than it collected. For a brief moment, it seemed possible that the U.S. might eventually eliminate its debt entirely. Economists at the time ran projections showing that if growth continued and spending remained stable, America could be debt-free by 2012. That world never came. Instead, the early 2000s delivered war, recession, crisis, and transformation. The terrorist attacks of 9/11, the wars in Iraq and Afghanistan, the dot-com collapse, tax cuts, the housing bubble, the global financial crisis, all of them reversed the surplus and accelerated borrowing. The national debt grew by more in the 20 years following 2000 than in the previous 2 centuries combined. And beneath all these events, one quietly devastating force was building: interest. Interest is an invisible tax on the future. It compounds. It snowballs. It makes yesterday's decisions more expensive today. And when national debt becomes large enough, interest becomes the machine, running the machine. In 2024, the US spent nearly 13% of its entire budget on interest alone. If interest rates rise instead of fall, that number climbs even faster. The CBO projection of $1.7 trillion in interest payments by 2030 assumes rates decrease. If they don't, the cost of carrying the debt could spiral. All of this raises a simple, terrifying question. If the debt is so big, so expensive, and so dangerous, why doesn't the United States just pay it off? Because buried beneath the $37 trillion number is a truth most people never learn. Paying off the national debt would break the foundations of the global economy. At first glance, paying off the national debt sounds like the ultimate responsible move. It's what every household is taught to do. Pay your bills, clean up your finances, live debt-free. But the United States is not a household, and its debt is not like any debt you've ever seen. What most Americans don't realize is that the national debt is the beating heart of the global financial system. It is not just owed, it is owned. And the people who own it are the very institutions that keep modern society functioning. Start with the most important debt instrument in the world, US Treasury bonds. These bonds are not just IOS, they are the foundation of global finance. Banks, pension funds, insurance companies, sovereign wealth funds, foreign governments, everyone uses treasuries as the safe asset of last resort. They are the closest thing humanity has to a risk-free investment. If the dollar is the bloodstream of the global economy, treasury bonds are the bones. And here's the first shocking truth. Paying off the US debt would eliminate treasury securities entirely. No more safe bonds. No more anchor for global interest rates. No more baseline asset for banks, retirement systems, or central banks. It would be like removing the keystone from an arch. Everything above it collapses. More than 2/3 of America's public debt is held domestically. That includes the Federal Reserve, mutual funds, pension plans, state governments, retirement accounts, and Social Security trust funds. Nearly $3 trillion alone is held by Social Security, money that millions of Americans depend on to retire. Another $4.5 trillion is held by the Federal Reserve, which uses those securities to control inflation, interest rates, and liquidity. If the debt disappeared, the Fed would lose its most essential tool. It would be like asking a surgeon to operate without instruments. Foreign nations also depend on US debt. Japan holds over $1 trillion of it. China holds close to $760 billion. The United Kingdom holds over $700 billion. These countries don't hold US debt because they like America. They hold it because nothing else is as safe, as liquid, as stable, and as globally accepted. If the United States suddenly eliminated its debt, it would not just impact Americans, it would send shockwaves through the entire global economy. But even if the US wanted to pay off its debt, the question becomes, how? There are only 3 ways, and every one of them would hurt Americans far more than the debt itself. The first option is to slash spending so drastically that every major federal program is gutted. Social Security, Medicare, public schools, hospitals, scientific research, roads, bridges, telecommunications, national parks, the military, all would need to be cut down to the bone. The government would essentially shut down the functions that define a modern society. Millions of elderly citizens would lose income. Healthcare systems would collapse. The military would face its largest defunding in US history. These cuts would trigger a depression long before the debt ever reached zero. The second option is to raise taxes to extreme levels, not by a few percent, but to something resembling 60 or 70% across the board. Such tax rates might be survivable for the wealthy, but they would devastate the middle class. Consumer spending would dry up, businesses would contract, growth would stall. The economic pain needed to generate enough surplus to eliminate $37 trillion is so severe that no democracy could survive. The backlash. The third option is to print money. But printing $37 trillion would collapse the currency. Inflation would rip through the economy. Prices would skyrocket. Savings would evaporate. Eventually, hyperinflation would set in. What happened in Zimbabwe or Weimar Germany would happen in the United States, and the most powerful currency in human history would dissolve into worthless paper. The global economy would be thrown into chaos, because without the dollar, there is no stable financial order. This leads to the strangest truth of all. The US debt exists because the world needs it to exist. It is the bedrock of global finance, the anchor of trade, the mechanism that allows central banks everywhere to function. Paying it off isn't just difficult, it's systemically impossible. But that doesn't mean everything is fine. The problem isn't the existence of the debt. The problem is its size relative to the nation's economic output. The debt-to-GDP ratio passed 124% in 2024. For decades, the world believed U.S. debt didn't matter because America was the most stable, trustworthy borrower on Earth. But cracks are appearing in that belief. The U.S. credit rating, once immaculate, has now been downgraded twice. In 2023, Fitch lowered America's rating from AAA to AA+. In 2025, Moody's lowered it as well, marking the first time in more than a century that the U.S. was not considered perfect. These downgrades weren't symbolic. They signaled something far more dangerous, that global investors are beginning to question whether the United States can keep its house in order. Even more alarming was what happened in 2025. Historically, whenever the stock market drops, money rushes into U.S. Treasury bonds as a safe haven. But in 2025, for the first time in memory, money fled away from U.S. bonds during a crisis. It was a warning shot, small, almost quiet, but unmistakable. When investors no longer see the U.S. as the safest place on Earth, the financial world begins to shift beneath our feet. As confidence erodes, the cost of borrowing rises. Higher interest rates mean more of the federal budget gets eaten by interest payments. The budget becomes tighter, the debt grows faster, and the cycle accelerates. This kind of feedback loop can lead to a crisis where the world stops seeing U.S. debt as risk-free, and once that perception breaks, it never fully returns. And when it becomes a problem, it becomes catastrophic in a way the modern world has never seen. America does not need to eliminate its debt. It simply needs to keep it stable relative to its economic strength. That means growth must rise faster than debt. Something that becomes harder each year the debt climbs and interest payments increase. Behind the $37 trillion number lies a fragile truth. The world still trusts America, but that trust is no longer infinite. And every fiscal showdown in Congress, every threat to default, every downgrade chips away at that foundation. The national debt is not a ticking time bomb. It is a slowly widening fault line, invisible at times, ignored by most, but capable of splitting the global economy open if mismanaged. So let me ask a question most people never dare to ask. If paying off the debt would destroy the system, what actually happens if the United States can't pay it? To understand the true danger behind America's $37 trillion debt, you have to confront the one scenario economists fear more than recession, inflation, or even a currency collapse. It is the scenario policymakers refuse to talk about in public, the scenario that keeps central bankers awake at night. It is the moment when the world's most powerful economy looks at the bill, looks at the interest payments, looks at the debt ceiling fights in Congress, and realizes it may not be able to keep its promises forever. A U.S. default. The very phrase sounds impossible. The United States has never fully defaulted in its modern history, not even during the Great Depression, not even during world wars. Not even at times when the government was running on fumes. The closest the nation ever came was in 1979, when a technical error delayed payments to Treasury holders. Even that brief glitch caused bond markets to panic and interest rates to spike. A mere paperwork delay shook the financial world. So imagine what a true default would look like, not because of a clerical mistake, but because Congress refuses to raise the debt ceiling, or because interest payments grow faster than tax revenues, or because global investors finally doubt America's ability to pay. It would begin quietly, not with an explosion, but with a whisper. Treasury auctions, the routine process where the government sells bonds, would suddenly attract fewer buyers. Investors would begin demanding higher interest to compensate for rising risk. Foreign governments would sell small amounts of their U.S. holdings. Nothing dramatic at first, but enough to signal a shift in confidence. The markets would notice immediately. Interest rates across the economy, mortgages, car loans, credit cards, business loans would begin to rise. Not because the Federal Reserve wanted them to rise, but because the underlying cost of borrowing for the U.S. government had increased. Remember, Treasury yields are the anchor for nearly every other interest rate on Earth. If that anchor moves, everything moves with it. The stock market would wobble. Large corporations, which rely on stable borrowing costs, would see their valuations fall. Banks would feel the pressure as the value of their Treasury holdings declined. Foreign markets would react next, because more than half of global trade and financial contracts are priced using the U.S. dollar. A shock to treasuries becomes a shock to the entire global system. Then the dominoes start to fall. Social Security might miss payments. Government employees might go unpaid. Military paychecks could be delayed. Medicare reimbursements would stall. Federal contractors would freeze operations. The government, unable to borrow, would be forced into immediate austerity, something no nation has ever successfully executed. During a crisis, spending cuts this sudden would rip through the economy like a chainsaw. Consumer confidence would collapse, businesses would halt hiring, layoffs would surge. But the real disaster comes next, because a US default would be unlike any financial crisis in history. There is no backup, currency ready to take over. No global financial architecture exists without treasuries at the center. Every pension fund, every insurance company, every multinational bank, every central bank on earth holds US debt. Striking the US Treasury market is like striking the load-bearing pillar of the entire global building. Currencies around the world would swing wildly. Oil and commodity markets would freeze because they rely heavily on dollar-denominated contracts. International trade would slow to a crawl. Entire countries that depend on the dollar for stability, from emerging markets in Africa to financial hubs in Asia, would face currency collapses. The global economy would convulse in ways that economists cannot fully model, because nothing like this has ever happened before. This is the nightmare scenario. And here is the ironic twist. The US government knows this. Wall Street knows this. Foreign governments know this. That's why a full default has never happened. The American financial system runs on a paradox. The debt is enormous, unsustainable, and growing faster than the economy itself. But the consequences of not paying it are so catastrophic that the world continues buying US bonds anyway. This is why economists say the US does not borrow because it wants to. It borrows because it must. Not paying would break the system. Paying it off would also break the system. The only sustainable path is somewhere in the middle, keeping the debt large, but manageable, growing the economy faster than the debt, preserving the illusion of infinite safety. An illusion is the correct word. A nation does not reach $37 trillion in debt by accident. It reaches that level because every president, every Congress, every administration, whether Democrat or Republican, has chosen short-term political comfort over long-term fiscal responsibility. No one wants to cut spending. No one wants to raise taxes. And no one wants to tell voters the truth, that the debt is manageable today, only because the world still trusts the United States more than any other nation. We saw hints of that fragility in 2023 and 2025 when the U.S. credit rating was downgraded for the first time in over a century. We saw it when foreign demand for treasuries dipped for the first time during a market sell-off. We saw it when the dollar's share of global reserves fell from 70% to 58%. These are not random data points. They are tremors before the quake. The terrifying truth is that America's debt is not a problem today, because the world believes in America. If that belief ever cracks, even slightly, the impact could be swift and irreversible. Interest cost would surge. Debt would snowball faster than any budget could control. And the very thing that makes the U.S. powerful, its ability to borrow indefinitely at low cost, would vanish. This is why economists say the U.S. debt is a problem that becomes a crisis only once the world decides it is. When confidence falters, the fall is immediate. And that brings us to the most important part of this story. What would the world look like if the United States could no longer rely on debt as the engine of its global power? What replaces the dollar? What replaces treasuries? What replaces a financial system built on trust that is now cracking? The answer leads us into the darker side of global finance, the competition for supremacy, the geopolitical shifts already underway, and the world preparing for a future where America is no longer the sole center of gravity. To understand why the United States can sustain a $37 trillion debt without collapsing, and why paying it off entirely could ignite an even bigger crisis, you have to understand a concept so strange, so counterintuitive, that even many economists struggle to explain it clearly. The United States does not issue debt simply because it overspends. It issues debt because the world demands it. The U.S. Treasury market is not a sign of American weakness. It is the very foundation of American power. Treasury bonds are the global financial system's equivalent of oxygen. Every economy on Earth breathes through them. Governments use treasuries as collateral for trade. Banks use them as reserves for stability. Investors use them as the baseline for risk. Central banks use them to manage their currencies. Entire pension systems depend on their reliability. The smooth functioning of everything from mortgages to international shipping lanes is tied to the assumption that the United States will always, without fail, pay its bills. If the U.S. ever stopped issuing debt, that oxygen would be cut off. This is why Treasury securities are often called the anchor asset of the world economy. They are considered risk-free, not because America is perfect, far from it, but because the global financial system was designed around America's economic and military supremacy after World War II, when the Bretton Woods agreements were drafted, placing the U.S. dollar at the center of global trade. The world essentially outsourced its economic stability to America. This arrangement came with extraordinary benefits for the United States. Other nations had to hold dollars and treasuries to stabilize their currencies, which meant America could borrow cheaply endlessly, and at a scale no empire in history has ever enjoyed. The US became the only country in the world capable of printing the global reserve currency and selling unlimited debt without fear of collapse. But here is the paradox. This privilege only works if America keeps issuing more debt, i.e. the US suddenly paid off its entire $37 trillion balance, or even attempted to significantly reduce it. The world would face a crisis unlike anything seen in modern history. There would be no safe asset left large enough, liquid enough, and trusted enough to replace treasuries. Global banks, hedge funds, insurers, and central banks would lose their primary financial tool. The plumbing of the entire financial system would seize up. This is why economists say the United States must maintain a perpetual debt supply. Treasuries are not just an investment. They are the infrastructure of global capitalism. But what happens when that infrastructure starts showing cracks? That is the question haunting economists today. Because the warning signs are multiplying. Interest payments on the national debt have quietly become the second largest line item in the entire U.S. federal budget, surpassing Medicare and approaching the Pentagon. The government now spends nearly $900 billion per year simply to service its debt, more than it spends on national defense. And the Congressional Budget Office predicts that within a decade, interest payments alone could reach $1.7 trillion per year. A nation that once borrowed to grow is now borrowing to survive. And this shift is not going unnoticed. The world is beginning, for the first time in decades, to question the invincibility of the dollar. Fitch downgraded the U.S. credit rating in 2023. Moody's followed in 20 to 5. The U.S. lost its perfect score for the first time since 1917. These downgrades were symbolic, yes, but symbolism matters in a financial system built on confidence. When the world's most powerful economy loses trust, markets begin quietly repositioning. The dollar's share of global reserves has fallen sharply, from 70% in 1999 to 58% today. 11 nations have reduced or eliminated the dollar as their primary reserve currency. Several major economies, including China, Russia, India, Brazil, and Saudi Arabia, have openly discussed building financial systems that operate outside of U.S. influence. Even during recent market shocks, foreign demand for treasuries dropped instead of rising, breaking a century-long pattern. This should terrify U.S. policymakers because global demand for treasuries is the only reason a $37 trillion debt hasn't triggered a crisis already. America controls the world's financial gravity only because the world still believes it has to. But belief is not permanent. Belief can erode. And beneath the surface, the erosion has already begun. Countries like China and Japan, once the largest foreign holders of U.S. debt, have been quietly reducing their positions. China, which held over $1 trillion in treasuries a decade ago, now holds around $759 billion. Japan has reduced its holdings multiple times in recent years to defend its own currency. These shifts may seem small, but in global finance, momentum matters. When the largest foreign creditors begin stepping back, smaller nations follow. Foreign investors used to buy treasuries automatically. Now they question the purchase. Banks used to rely on treasuries without hesitation. Now they diversify their reserves. Nations used to tie their currencies to the dollar out of necessity. Now they explore alternatives. None of this means the dollar is collapsing, but it does mean the world is preparing for a future where the dollar is not the only anchor. And that future changes everything. Because once the world stops needing as many treasuries, the U.S. loses the ability to borrow cheaply. Interest rates rise. Debt servicing costs explode. Programs like Social Security, Medicare, and defense become impossible to sustain. The American middle class feels the impact first, through higher mortgage rates, higher taxes, slower growth, and fewer opportunities. This is the danger of losing confidence. The U.S. doesn't need to default for a crisis to begin. It only needs foreign investors to lose faith gradually. And faith always disappears gradually, until it disappears suddenly. This is why the U.S. cannot pay off its debt, yet cannot afford to let it grow unchecked. It is trapped in a paradox of its own engineering, addicted to borrowing, dependent on foreign confidence, and forced to issue the very debt that is also threatening its future. It is a treadmill that cannot be stopped, a cycle that cannot be escaped, a system that works until the moment it doesn't. But the most shocking part of this story is not how much the U.S. OWEs. It is who benefits the most from keeping America in debt, and why those same forces would never allow the debt to be paid off even if the government tried. Because behind the Treasury market lies a hidden network of institutions, banks, and sovereign nations that rely on you. Debt not just for profit, but for power. To understand why the United States will never, can never, pay off its national debt, you have to follow the money. Not the money owed, but the money earned. Because every dollar the U.S. Treasury borrows becomes someone else's asset, someone else's tool for controlling the world economy. And when you look closely at who those someone else's are, the entire picture of American debt transforms from a burden into a business model. And most powerful beneficiary of America's $37 trillion debt is the institution almost no one ever thinks about, the Federal Reserve. The Fed is not simply a referee in the financial system. It is the primary dealer, the buyer of last resort, the issuer of liquidity, and the hidden architect of every major economic cycle. When the U.S. issues debt, the Federal Reserve purchases massive quantities of it, holding more than $4.5 trillion in treasuries. The Fed uses these securities as the raw material for monetary policy, injecting or withdrawing money from the financial system to stabilize prices, prop up markets, or rescue banks in moments of panic. If the national debt disappeared tomorrow, the Federal Reserve would lose its most essential tool. It could not perform open market operations. It could not manage interest rates. It could not regulate liquidity. Its ability to steer the U.S. financial system, and by extension the global financial system, would collapse. The Fed needs U.S. debt the same way a surgeon needs oxygen, not as an option, but as a precondition for survival. The second major beneficiary is the global banking system. This is where the picture widens, and where the truth becomes harder to ignore. Banks around the world, private banks, central banks, investment funds, pension funds, sovereign wealth funds, treat U.S. treasuries as the safest, most liquid collateral in existence. The entire architecture of modern finance depends on this collateral being abundant, predictable, and backed by the world's strongest military. When a European bank wants to borrow cheaply, it uses treasuries as collateral. When a Japanese insurer wants to hedge long-term liabilities, it purchases treasuries. When a sovereign wealth fund wants to protect trillions in national savings, it stores those trillions in treasuries. If the U.S. suddenly stopped issuing debt, the collateral chain that underpins global lending markets would collapse in weeks. There would be no accepted substitute large enough to fill the gap. Not euros, not yen, not gold, not cryptocurrencies. The demand for treasuries is not just theoretical. Financial institutions do not merely prefer U.S. debt. The third beneficiary is the U.S. government itself, not because it can borrow endlessly, but because borrowing endlessly preserves American geopolitical dominance. Every treasury bond purchased by a foreign nation is an acknowledgement of U.S. power. It signals trust in the American legal system, faith in the American economy, and dependence on the American dollar. Nations do not buy treasuries because they love the United States. They buy them because the global system forces them to. This is the quiet genius of the post-World War order. The United States convinced the world that its debt was as good as its currency, and its currency was as good as gold. This allowed America to finance its military, maintain its global bases, project power across oceans, and influence foreign governments without firing a shot. As long as the world holds U.S. debt, the world indirectly funds American strength. This is why, despite political theater and public debates, no Washington administration, Republican or Democrat, has seriously attempted to reduce the debt in any meaningful way. The debt is not a mistake. It is a strategic asset. But the most surprising beneficiaries of the national debt are not governments or banks. They are the massive pension systems that support hundreds of millions of workers, teachers, firefighters, nurses, veterans, retirees. Pension funds rely on stable, predictable returns to meet their obligations, and U.S. treasuries are the only asset class large enough to match the scale of their liabilities. Without treasuries, pensions would implode, retirements would evaporate, state budgets would collapse under the weight of their own promises. Treasuries are the invisible spine of the social contract. Remove them, and the contract breaks. But as powerful as these institutions are, and global elites who treat U.S. debt as a shield and a lever, they use treasuries to protect their wealth, hedge against crises, and influence policy through markets rather than elections. Their fortunes rise when uncertainty rises. Their influence grows when governments struggle. Their portfolios expand when nations borrow more. To them, debt is not a danger. Consider what happens during every major crisis over the last 50 years. The stock market crashes. Commodities swing wildly. Cryptocurrencies collapse. The national debt is, paradoxically, one of the greatest wealth preservation tools ever invented. And those who understand this dynamic, the billionaires, the fund managers, The global institutions benefit most from a system where debt keeps growing. This dynamic creates a powerful incentive that no politician ever mentions. The elites who control global capital do not want America to shrink its debt. They want it to grow. A larger Treasury market means more liquidity, more collateral, more stability for their wealth. A shrinking Treasury market would reduce their leverage, reduce their influence, and reduce the financial architecture from which they profit. This is why the national debt rises under every president, regardless of party. Why Congress fights endlessly over deficits but never reverses them. Why the Federal Reserve cannot shrink its balance sheet without triggering panic. The system is designed to expand, not because Americans are irresponsible, but because the world is built on the assumption that the United States will supply more debt every year. But this dependence has a darker consequence, one that economists rarely say aloud. If the U.S. debt ever becomes genuinely unsustainable, the collapse will not begin in America. It will begin in the countries, institutions, and pension systems that rely on U.S. Treasuries as the foundation of their stability. The crisis would travel outward, not inward. It would hit Europe first, Asia second, developing markets third, and only then circle back to the United States. The world needs America's debt so badly that the world cannot allow America to fail. But the world cannot support America forever. Because beneath all these beneficiaries, the Fed, the banks, the funds, the foreign buyers, lies a simple truth that no institution can fully escape. A country cannot borrow endlessly without consequences. And the first cracks of those consequences are already visible in the form of rising interest cost, falling foreign demand, shrinking dollar dominance, and political paralysis in Washington. This is where the story turns. A strategic advantage. But the moment interest payments start approaching $2 trillion per year, the moment the U.S. is borrowing money just to make minimum payments, the tool becomes the threat. And that threat is emerging faster than anyone expected. The great paradox of the American debt system is that it works. For decades, the United States enjoyed a unique immunity to the consequences of overspending. Its currency anchored global trade. Its military guaranteed stability in regions thousands of miles away. And its economy was large enough, innovative enough, and trusted enough that even reckless fiscal behavior seemed to generate no real penalty. And America's $37 trillion debt is now approaching the stage where the laws of arithmetic begin to challenge the laws of empire. The first signal of stress comes from a place almost no one pays attention to: interest payments. In 2024, the United States paid $890 billion in interest alone, more than it spent on defense. Interest, a bill that produces nothing, creates nothing, builds nothing. It is the weight that grows heavier the longer you ignore it. It spends on its entire military and welfare systems combined. When a nation pays more on interest than it spends defending itself, it signals not just a budgeting crisis, but an existential one. For the first time in modern history, foreign buyers are quietly stepping back from U.S. debt. China has reduced its holdings. Even traditional allies like the United Kingdom have shifted some capital into alternative reserves. Investors are beginning to ask whether the United States. The third signal is more subtle but more dangerous: the weakening of the dollar's global dominance. Between 1999 and 2024, the dollar's share of global reserves fell from 70% to 58%. Not because they expect the dollar to collapse. And the first stage of that fall is always confidence erosion. As political polarization grows, Congress finds itself unable to pass budgets. This transforms the national debt from a financial challenge into a political liability. In past decades, the United States could rely on unity in crisis. When spending obligations for Social Security and Medicare overwhelm tax revenues, a debt spiral begins quietly. Investors demand higher yields to compensate for higher risk. Higher interest costs require more borrowing, feeding on itself until the nation reaches a point where the debt grows faster than the economy. But here is the uncomfortable truth the public rarely hears: the United States cannot default in the traditional sense, not while it controls the world's reserve currency. Instead, the danger comes from a slower, more insidious form of default: an erosion of purchasing power, a debasement of the currency, a decline in real wages, a rise in inflation that eats the savings of ordinary citizens, while protecting the balance sheets of the elite. Historically, nations avoid default through inflation. It is the softest, quietest, politically safest form of debt reduction. It transfers wealth from savers to borrowers, from citizens to governments, from future generations to current policymakers. And in America's case, inflation becomes a tool of survival. Few voters will accept higher taxes, and no nation on earth can simply pay off $37 trillion without breaking itself in the process. So the inflation option becomes the default option. But inflation brings its own set of consequences. It pushes mortgage rates up, making homeownership harder for millions. It raises the cost of food, fuel, medicine, and education. It widens the gap between asset owners, who profit from rising prices, and workers whose paychecks lag behind. It transforms wealth inequality from a problem into a structural imbalance, and these imbalances create political instability, which in turn raises borrowing costs, even further a feedback loop that magnifies the original problem. This is the hidden reality. The national debt does not simply affect the economy. It affects the social fabric. It affects retirement plans. It affects job stability. No empire in history has maintained its dominance while running permanent deficits of this magnitude. Ancient Rome learned it in the final century of its republic. Spain learned it during its silver-fueled inflation crisis. Every empire believes it is the exception until the moment it isn't. The United States still holds the most powerful economic tools in the world. It has unmatched innovation, unmatched productivity potential, unmatched demographic advantages compared to Europe and East Asia, unmatched immigration capacity. The decline of foreign confidence is not a prophecy, it is a warning. And that is why economists and investors watch the debt-to-GDP ratio more closely than the absolute debt number. As long as the U.S. economy grows faster than the debt, the system remains stable. But once the debt grows faster than the economy, the countdown begins. It may take years. If the United States restores fiscal discipline, reforms entitlement spending, modernizes tax structures, and reins in interest costs, it can preserve its global dominance for another century. If it fails, the world will gradually shift away from the dollar, away from treasuries, away from American leadership, not through war, not through revolution, but through silent migration of capital. The national debt is the scoreboard of a nation's priorities. If the U.S. continues on its current trajectory without reform, but if it takes the warning seriously, it can transform this moment into a turning point. The same way it transformed crises in 1873, 1933, 1980, and 2008 into new eras of strength.